When economists start to tell you that you have a recession and therefore you shouldn't own stocks, keep in mind economists have predicted like 13 of the last 3 recessions. I think Bitcoin has now become accepted enough that it's part of people's steady buying. I think there's plenty of now traditional finance investors stacking Bitcoin. We got to 3,900, so we're within 100. I think that's within the standard error of a prediction. I think every bounce since COVID has been a hated bounce. Because if someone was personally realistic and introspective, they didn't believe we could recover from that initial COVID decline because the world economy shut down.
In the rapidly evolving world of finance, digital assets are no longer fringe, they're foundational. According to veteran market strategist Tom Lee, we are witnessing the normalization of Bitcoin into traditional investment portfolios. Bitcoin's resilience above the $100,000 mark has shattered prior resistance theories and sparked steady accumulation from institutional players. Meanwhile, Ethereum is experiencing a renaissance, fueled by Wall Street's growing appetite for tokenization infrastructure. Lee sees Ethereum's rock-solid uptime and legal recognition in the US as major trust signals for institutional adoption. As we look forward, macroeconomic factors such as Federal Reserve easing and global liquidity influxes could act as catalysts for the next exponential surge in crypto valuations. Lee envisions Bitcoin rising conservatively to $250,000 and Ethereum to $15,000 in the near term, driven not by hype but by structural financial shifts. This is no longer speculation, it's a paradigm shift in global capital formation.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
I think it's like someone who just months ago would have said, well, Bitcoin can't hold 100,000. I mean, how many people said that Bitcoin wasn't going to hold 100,000 because one, there's nothing supporting it or there's no new buyers behind 100,000. But guess what? Bitcoin's 120,000 now. In fact, I think that there's plenty of new buyers for ETH above 4,000. So to me, I think 4,000, if someone's thinking that that's like a level of resistance that represents something super meaningful, to me, I think it's paper. I think Bitcoin has now become accepted enough that it's part of people's steady buying. I think there's plenty of now traditional finance investors stacking Bitcoin, and they're buying it every month. And I think that's why it's holding steady here. And to me, for Bitcoin really to make its next quantum move, I do think it's dependent on global liquidity. And so the Fed, as you know, is on hold. But if their next move is to hike, then the entire stock market really is going to have to fight through that. It won't necessarily decline, but it has to fight that. And the Fed argument there would be, well, the economy is so healthy, I should be raising rates. But the reality is, at this point in the cycle, the Fed should be easing. It's a question of when. And if they begin easing in the fall, then I think that's going to coincide with Bitcoin making a step function higher. And I still think 200 to 250,000 is possible. If Bitcoin gets to 500,000, and we're talking 5 years from now, gold's network value probably is close to 27, 28 trillion. So he's just saying Bitcoin will be valued at 1/3 as digital gold, merely as digital gold. And so I think that's conservative. I mean, I think it won't take 5 years for Bitcoin to supplant the network value of gold. So that's why I think when you see something like Cathie Wood at ARK predict over $1 million for Bitcoin, that to me 5 years from now makes more sense. And we got to 3,900, so we're within 100. I think that's within the standard error of a prediction. But to me, Ethereum is being rejuvenated, right? Because we know the community has been galvanized, and we know that there's just an army of interest coming because of the tokenization Wall Street wants to do, and they are choosing to do it on Ethereum. So I think when you think about the future value of activity, it needs to start getting discounted on Ethereum. And I think that's why the price still needs to adjust higher. And I think I mentioned that if we use multiples similar to Circle, you get to 15,000-ish for ETH, and that would just be a today value. So I think ETH is still undervalued. But we also know, I mean, just from a trading perspective, look, there's a lot of people who think ETH has become sclerotic, like it's a stale layer one. There's more things happening on Solana or Sui, but the reality is that ETH is a legally recognized blockchain operating within the US, and it's never had any downtime. I thought it was so interesting that Vitalik, on the 10th birthday of Ethereum, notes zero downtime. That matters to Wall Street. I actually think that's almost a little bit of a hat tip to Wall Street because banks care about zero downtime. But then, as you know, there's people who have a pair. They like something else and they're short ETH. So I think 4,000 is a line in the sand. But to me, it's just a matter of time. When economists start to tell you that you have a recession and therefore you shouldn't own stocks, keep in mind economists have predicted like 13 of the last 3 recessions. So I think that has made this the most hated rally. And that's why, of course, once we broke to new highs, stocks have been levitating and there's still a lot of cash on the sidelines. I think every bounce since COVID has been a hated bounce. Because if someone was personally realistic and introspective, they didn't believe we could recover from that initial COVID decline because the world economy shut down. And then when stocks tanked because Fed Chair Powell initiated the fastest rate hikes in history and stocks tanked in 2022, I know that every one of my institutional investors said, Tom, there's no way stocks can come back. Not every, but most, because they said the Fed is trying to engineer a recession. So those 2 rallies were very hated. This rally, because stocks tanked because of tariff Armageddon. And we have to keep in mind that if you look at political donations or political affiliations, 60% of professional stock investors voted for not President Trump. They voted for someone else. And that means that the stock market does not believe the Trump agenda. And that's why when stocks fell in April and we talked about a waterfall decline, having symmetric bounces unless there's a recession, it was met with skepticism because the pushback was the Fed is not going to unleash liquidity. So there's no way you're going to get a V-shaped bounce. Well, we got a V-shaped bounce. In fact, that is consistent with history. And I think what makes people really hate these rallies is that since the end of 2019, economists have become very important voices in macro decisions. I would say that if I was just to overlay what I see as activity, and that's what's being reported by exchanges, and Robinhood, as you said correctly, is essentially really geared as a crypto play, to me, it doesn't seem late cycle. I think it's actually possibly mid-cycle for crypto. But then I've heard some people say that this crypto cycle could be changing because there's now institutional involvement. And as you know, when you look at a traditional cycle for a risk asset in public markets, not in crypto, there's four cohorts that ultimately drive the top in a price cycle. You know, it's retail, it's high net worth, it's institutions, and then it's family offices. And until all 4 cohorts are really all in on a sector, you never see a peak. And that's excluding the global aspect of crypto. So to me, I think that there's been robust results reported, but I think to me, especially when I look at the sponsorship and ownership of equities like Coinbase or Robinhood, it still doesn't feel late cycle. It's an actual bed. It's a bed that I use because I sometimes have super early mornings or super late nights, or I've come back from somewhere and I've taken the red eye, so I need to take a few minutes to mentally recharge. Yes, so it's actually a bed.
Tom Lee outlines a strong case for why crypto is mid-cycle, not late stage. He breaks down institutional cycles across 4 cohorts: retail, high net worth individuals, institutions, and family offices. Today, all 4 are not yet fully allocated, signaling that we're nowhere near the top. Ethereum in particular is undervalued given the exponential rise in stablecoin usage and tokenization efforts, most of which are anchored on Ethereum's legally compliant and rock-solid blockchain. Ethereum's utility is no longer speculative. It's becoming Wall Street's programmable layer. As for Bitcoin, its path forward is shaped by macro liquidity. Lee argues that once the Fed begins easing again, likely in the fall, it could propel Bitcoin into its next quantum move. Historical price action supports this. Hated rallies often yield the strongest returns. From the COVID crash to tariff-driven sell-offs, investors have misread resilience for weakness. Today's quiet bull market is laying the groundwork for a financial reordering driven by digital assets.
Well, I think the key to keep in mind is Bitcoin is demonetizing foreign real estate, private equity, public equity, other sorts of store of value assets everywhere in the world. 20th century physical analog assets are becoming 21st century digital assets. Bitcoin is a digital commodity. It's about 50 volatility, 50 ARR, and you want to hold it forever, a 50-year duration asset.
Okay.
If you want amplified Bitcoin, MSTR, the equity, is amplified Bitcoin. People want 2x Bitcoin exposure. The options jockeys love this. The derivatives traders love this. If you want structured Bitcoin, that's Strike, STRK. We give you like the 80% of the upside, and we give you 20% in a structured dividend, and then we give you principal protection. That's for people that would prefer to invest in hedge funds or S&P index. You know, we started and we had very little, and Bitcoin was 10,000, and now Bitcoin's more than 100,000, and 97% of the Bitcoin is worth 10 times as much, and somebody else, not us, has it. Right. So as a practical matter, what we're doing is we're monetizing and powering up this.
I totally get it. I just mean, if you owned all of it, would that change the entire behavior of Bitcoin?
Yeah, we wouldn't want to own all of it. We want everybody else to have their piece. The nice thing there is there's 160 companies that are capitalizing on Bitcoin in the public market, up from about 60 last year. So the Bitcoin treasury movement's exploding. And companies like Metaplanet in Japan, and Capital B in France, and Smarter Web in the UK, and then there's a raft of them in the US, Anthony Pompliano's company, you know, and 21. They're all capitalizing. The big idea is I take digital capital, I issue digital credit, and a digital credit instrument can either be longer duration or it can be higher performance. We're offering 9% dividend yield with Stretch. The average money market's 4.2% dividend yield. No one would ever want to give a 9% perpetual yield in a bond that's backed by real estate or backed by gold or backed by any conventional fiat asset. But we're investing in Bitcoin, and my 20-year forecast for Bitcoin is 30% a year ARR. So, well, I think the key to keep in mind is Bitcoin is demonetizing foreign real estate, private equity, public equity, other sorts of store of value assets everywhere in the world. 20th century physical analog assets are becoming 21st century digital assets. These companies like Apple and Microsoft, if they could buy the S&P index, they'd be better off. It's against SEC rules. Right. If they could buy each other's securities, if the Mag 7 could buy each other's securities, they would be better off. That's against SEC rules. The only security Apple can buy is Apple stock. And what do? They buy their own security. So, and generally, if you're trying to create shareholder value, you don't want to park it in a fiat currency. You want to park it in a tangible asset.
Michael Saylor takes the long view, one that sees Bitcoin not just as an investment, but as a monetary revolution. According to Saylor, Bitcoin is demonetizing outdated T20th century assets like foreign real estate, bonds, and equities. In their place, Bitcoin emerges as a 50-year ultrasound digital commodity, engineered to store value in a decentralized, censorship-resistant way. Saylor points to the explosion of companies monetizing Bitcoin in public markets as evidence of this shift, citing firms across the US, Europe, and Asia. He outlines a future where digital capital powers digital credit, offering structured returns like 9% perpetual yields backed by Bitcoin. Traditional markets can't match this without taking on exponential risk. In essence, Bitcoin is becoming the reserve asset of the digital age, offering asymmetric upside with unparalleled security. For Saylor, Bitcoin isn't just money. It's the base layer of a new financial system, one that outperforms fiat and redefines how capital is stored and grown.